The following is an excerpt from an askSlim premium level video. Follow us on YouTube, give us a thumbs up if you like this video, and do subscribe to this channel on YouTube. Share it. There's tons that come out every single week. Follow us on Twitter at askSlim, and write to Matt at askSlim.com for trial memberships. We have trial memberships available for all of our levels, 1, 2, 3, and 4. And go to the askSlim.com website for details. Thank you, and enjoy the video. Now we're going to switch over and we're going to look at the stock market. So the stock market had massive gains. The rebound came from very, very depressed levels after the stock market had its biggest decline ever. Yeah, 35% approximately in something like 4 weeks or a few days less. It was an astounding cascade of selling that came into the markets on the downside. When that happens, when you look at almost every single bear market that began, you can go back and look at the tops all the way in 2007 or 2000, 1962 or 1929, or any of these tops. Almost every one of them that had a sharp decline. Now remember, even the Great Depression didn't start with a decline this big, though it eventually in another few weeks it ended up down 50%. There was always a rebound back, and the rebounds were usually somewhere between the 50% and the 78.6%. So right now we're getting up just to the 50%. It is not an unusual condition for that to happen. And then after every one of those, the bear market started to take a hold. Now the Fed is trying to stop that from happening. They're trying to stop because the economy is shut down. They don't want everybody to think that they lost everything, including every one of their assets they had in the stock market, which were inflated in value in the first place. So that's what they're trying to stop. So right now what we're going to do is we're just going to look at the short term, but the short term is always affected by that intermediate and longer term. And the intermediate forces are now sharply to the downside. So the upward movement is fighting, that short-term upward movement is fighting this downward movement, and that's why you fall afterwards and you stall between that 50 and 78.6%. So here is that ZBs, and now we're going to move over to the SPX, and you'll get a sense for what I mean by a massive downward movement that we had right in here with this a big decline. And when the slim ribbon turned negative momentum right over here, it just lost 1,000 points so fast in the S&P 500. We talked about the early bottom right over here and the anticipation that we would get a rally to the upside. None of this is a surprise. What is a little bit of a surprise is that we thought, based on the extent of the weakness, that the market would stall right around the 26, 60, 70 area, but you could see it's done better than that. And here's that 50% recovery level right over there. Here's the 61.8. I don't expect it to get up here to the 78.6, but these are still reasonable numbers. Now, for the short term, what we're looking for is that this upward corrective period will remain in play until somewhere out into May. So in other words, this cycle is rallying, it then peaks, it comes down and corrects, and very likely only corrects into this zone, even in the midst of a very bad bear market. That we believe this is a buy zone because the intermediate pattern has turned upward. So with the intermediate pattern in an upward correction, that makes this a buy. That means if you dip down over here to somewhere between 2570, 25, that's actually about 66 right over there, and right over here around 2500, that really is our buy zone, the upper part of that right there. There's a high probability the market will decline into this period right over here. Markets move up through a good portion of the cycle, and then when they release and then begin to come down, they have the sharper declines, as you see right there. If this extends up a few more days right in here, then it will shorten the time period and raise the projection over here. The market will tell us, and that's what we really want to happen. But the probability is high that the market will retreat in here. We're going to call the next 1 to 1.5 weeks a move back downward over here into the buy zone and then move up again. If it takes a couple days to make that downward turn, it's going to raise these levels over here, so we'll be cognizant of that. And then another period out over here of a short-term potential rally back up into these zones, back up near the 2800 level, and potentially getting up here to this area of around 2930, 2935. So this is the trend that you see in here, that we see. This is looking to us like a short-term upward trend living within an intermediate-term rebound that all lives within a longer-term, very bad bear market condition. So there's 3 different time frames I told you about right there. But the downward, heavy downwards condition that we see in the longer term is not affecting this as much right now because the market is in a rebounding period. So we're going to look for this coming week for a decline, lasting about a week and a half, and then moving up again. Momentum has now turned neutral. That is a much better condition. Overall, we're just going to look in the next week, week and a half for this range-bound area, just over 2,800, just down to around 2,566 or a little bit lower, and then moving up again. The sum of the evidence is that we are in a very big rebound from a deeply oversold condition. The patterns that exist in the intermediate condition are negative. Overall momentum for the negative and is for the intermediate and longer term is negative, and the sum of the evidence says the highest probability is that this is a rebound in an ongoing bear market that is going to rear its ugly head again in a very big way. Short-term traders, this is the short-term view. There's room in here to trade both sides of this as we see it.